Just imagine this. A country where getting something delivered isn't just like dinner in 30 minutes. We're talking groceries, electronics, maybe even flowers, all showing up, bam, in just minutes. India's on-demand scene it's moving incredibly fast, really changing what convenience even means. So today, we're going to take a deep dive into the latest numbers from one of the big players there, Swiggy Limited.
That's right. We've got Swiggy's Q1 results for their fiscal 26, so that's the quarter ending June 30th, 2025. And Swiggy, well, it's this huge on-demand platform, right? Food delivery, Instamart for quick commerce, other stuff too. These numbers are fresh, post-IPO, giving us a really good look at how they're doing across the board.
Exactly. And our mission here isn't just to read out the numbers. We really want to unpack them. Understand the strategy, what Swiggy's actually doing, what does it mean for where the company's headed, and maybe more importantly, what does it mean for you? Whether you're using the service, watching the market, we're just curious about this whole digital economy thing. We've gone through their financials, the earnings call, shareholder letters, trying to pull out the key stuff. So let's get into it. Okay, so first up, the big picture. The overall financials for Swiggy this past quarter, Q1 FY26. Growth-wise, the numbers definitely pop. Their total platform gross order value, that's B2C GOV, hit INR 14,797 crore. And just for context, a crore is 10 million rupees, so we're talking roughly 1.75 billion US dollars, just massive scale. That GOV number is up 45.2% compared to the same quarter last year. Pretty significant.
Yeah, really significant growth. And following that GOV, their consolidated adjusted revenue, that climbed too. INR 5,308 crore. That's up 52.7% year on year. So top-line growth is looking very strong. But it's also worth noting their consolidated adjusted EBITDA loss. It did tick up a bit, went from INR 732 crore last quarter, Q4, to INR 813 crore this quarter, which, reflects that they're still investing heavily while they're growing so fast.
Right, that makes sense. Growth phase, heavy investment. But okay, with that loss ticking up, how's their cash looking? They reported cash and cash equivalents at INR 5,354 crore. Is that a comfortable spot?
It's definitely a strong balance sheet. That's a good amount of cash. And you have to remember the context here. These results are right after their IPO back in March 2025. They raised INR 4,359 crore from that. So they just topped up the bank account, basically.
Yeah.
Which is crucial, right? Because now they're a public company. They're navigating these really intense market dynamics, trying to balance that aggressive growth and innovation with, well, shareholder expectations and showing a path to profit.
Absolutely. That public company pressure changes things. Okay, let's zero in now on Instamart. That seems to be the real growth engine lately. Quick commerce, I mean, the growth there is described as explosive. GOV shot up 108% year on year and 21.1% just from the previous quarter, reaching INR 5,655 crore. Wow. What's fueling that?
Well, a huge driver, and actually a really impressive strategic win for them, is the jump in average order value, the AOV. It went up 25.6% year on year and 16% just quarter on quarter, hit INR 612. And what's interesting is that it actually beat their own guidance. So something's working really well there.
Okay, INR 612 AOV. And I read a big part of that was something called Max Saver. Can you explain that? What is it and why is it working so well?
Yeah, Max Saver. It's essentially a way to get people to build bigger baskets. It offers discounts or better value if you spend more, kind of like buy more, save more. And it's been really key. They said it reached 28% penetration among their monthly transacting users. Now, it might mean people order slightly less often because they're consolidating trips, maybe, but it drives up the value per order, helps with cart consolidation, and importantly, seems to improve customer retention. And the long game here is improving the contribution margin because other players, sellers, brands might start investing more in these promos too, sharing the cost, essentially.
Ah, okay. So it nudges behavior towards bigger, potentially more profitable orders. And it's not just about groceries anymore, is it? Sounds like the mix is changing too.
Exactly. Non-grocery items now make up 18.5% of Instamart's GOV. That's way up from just 7% a year ago. And that's not just happening by accident. They've deliberately expanded the range of products, up to 30,000 different items, SKUs, in major cities. So yeah, having that wider range helps push up the AOV naturally, and it makes Instamart more than just a quick grocery stop. It's becoming more of a general convenience store delivered fast.
That's a pretty significant shift. So, okay, growth is booming, AOV is up, product mix is broader. How are the actual margins looking for Instamart? Because quick commerce is famously tough, right?
It is tough. But they are showing improvement. The contribution margin improved to max 4.6%. It's about 97 basis points better than the previous quarter. So almost a full percentage point improvement. Remember, contribution margin is revenue minus the direct costs of that sale, like delivery, before overheads. so losing slightly less per order, which is good progress. Now, there were some pressures working against that, like the full impact of expanding their dark store network last quarter and lower take rates on some non-grocery stuff, but those were apparently offset by things like more ad revenue, being smarter with customer discounts, and just getting more efficient as those order values went up.
Okay, so improving, but still negative 4.6%. It's still losing money on contribution level, and the overall segment loss was significant too.
Yes. Instamart reported an INR 896 crore loss for the quarter on an adjusted EBITDA basis.
Yeah.
But again, the margin trend is positive. The adjusted EBITDA margin improved to negative 15.8%, up from negative 18.0% last quarter. Management sounds confident they can get that contribution margin to break even somewhere between Q3 of this fiscal year and Q1 of next, so maybe within the next 6-9 months. But they also admit competition is fierce, and they'll keep spending on marketing. It's definitely a long-term play. Build scale first.
Right, investing for market share. What about the physical footprint? The dark stores for Instamart, are they still adding those at a crazy pace?
It seems like the strategy there has shifted a bit. It's more measured now. They added 41 dark stores this quarter. Total is now 1,062 stores across 127 cities. That's about 4.3 million square feet of space. But the focus now seems to be on, as they put it, sweating the network, getting more out of the stores they already have. They actually said their current network could probably handle double the current volume without needing a massive build-out. That's huge for future capital spending. And they're still nailing the delivery speed averages around 12.6 minutes nationally, which is frankly amazing.
Wow, 12.6 minutes average. Okay, optimizing the existing network makes a lot of sense. Let's shift back to the core business then. Food delivery. This was their foundation, right? Still showing interesting trends.
Absolutely. Food delivery GOV, it grew a very healthy 18.8% year-on-year, reached INR 8,086 crore, and importantly, they added 1.2 million monthly transacting users, MTUs. That brings them to 16.3 million. They highlighted that this was their strongest MTU addition in 2 years. So the core business is definitely not stagnating. It's still attracting users.
That is strong user growth. But I did notice the adjusted EBITDA margin for food delivery dipped slightly, down to 2.4% from 2.9% in Q4. Why would that happen if users are growing?
Yeah, they address that. It seems mostly seasonal and investment related. Q1 in India, you have things like reverse migration for harvest season, plus the start of the monsoons. Both make having enough delivery partners available a bit more challenging and potentially more expensive. Plus, their annual appraisal cycle for employees hits in Q1, so manpower costs go up temporarily. Management expects this margin dip to normalize later in the year, so not a structural decline, more of a blip.
Got it. Seasonal factors. So it sounds like they're not just resting on their laurels in food delivery either. They're actively innovating, especially around making it cheaper.
Definitely. Affordability is a big push. They mentioned things like Pockethero, crazy deals, and a new thing called the 99 store. Now, this 99 store offers meals for, well, 99 rupees, so just over $1, focused on quick prep items. It's in over 175 cities, and they offer free delivery if you order above a certain amount. The idea here is clearly to broaden the market appeal, attract maybe younger users, Gen Z who are more price sensitive, drive more orders, keep people coming back, make it an everyday option, not just a treat.
Making it more accessible. And they're still pushing speed in food too, not just Instamart. You mentioned Bolt.
Yeah, relentless on speed too. Bolt is their 10-minute delivery service for certain quick prep food items. It's just already across 500 plus cities, and apparently doing over 10% of their total food delivery volume, which is quite something. Interestingly, they said Bolt orders might have slightly lower AOVs, but the delivery cost is also lower, so the economics kind of work out similarly to regular orders. They also have 1BLCK for their premium subscribers, offering benefits, and EcoSaver, which focuses on batching orders for efficiency. Lots of different angles.
And then there was Snack. What's the deal with that one? Sounds different again.
Snack is interesting. They classify it under platform innovations. It's focused on really low AOV items, snacks, drinks delivered via a micro kitchen model. The idea is it's incremental. It doesn't cannibalize regular food orders, but targets completely new times or needs, like, a 3 p.m. coffee and biscuit run. They described it as being in an early journey of discovery for the economics. So very experimental, exploring a potentially huge market for tiny, quick deliveries.
Interesting. Micro kitchens for snacks. Okay, but the food delivery space itself, it's super competitive in India, right? Any news on that front? Like new entrants?
Yeah, competition is always intense. One interesting development they mentioned is Rapido. Rapido is primarily a bike taxi service, but Swiggy actually holds about a 12% stake in them. Now, Rapido has announced they're planning to get into food delivery themselves. So Swiggy is now actively reevaluating that investment because, well, It's a potential conflict of interest, right? Competing with your own investment. Despite that, Swiggy expressed confidence they can handle the competition. They feel their consumer knowledge, innovation, and focus on making money sustainably will see them through. But it definitely shows how dynamic that market is.
Yeah, that's a tricky situation with the Rapido stake. Okay, moving beyond the two big ones, food and quick commerce. What about Swiggy's other businesses?
They touched on those too. Their out-of-home segment, that includes things like dine-out restaurant discovery and step-out events, saw really strong GOV growth, 61% year-on-year. And importantly, it remained profitable, with the adjusted EBITDA margin actually improving slightly to more 5%. The supply chain and distribution business also grew revenue fast, 78.1% year-on-year, and its losses narrowed, with the margin improving to minus 2.7%. So these smaller segments are contributing, diversifying revenue, and leveraging their existing logistics muscle.
And those platform innovations where Snack sits, still mostly in investment mode.
Pretty much. That segment is like their R&D lab for new ideas. It reported an adjusted EBITDA loss of INR 52 crore for the quarter, which is totally expected for ventures that are just starting out and being tested. It shows they're still placing bets on future growth areas.
Right, got to keep experimenting. So finally, then, let's circle back to the overall financial health. Cash flow, capital expenditure. Given all this spending, especially on Instamart, are they feeling okay about their cash runway?
They address this directly. They seemed comfortable with that INR 5,354 crore cash balance. They explained that a chunk of the Q1 capital expenditure, the CapEx, which was INR 319 crore, was for stuff like warehouse expansion and paying for dark stores they'd already started building previously. Crucially, they expect future CapEx needs to actually decrease. Why? Because they feel they've front-loaded a lot of the network expansion. They've built capacity ahead of demand. And they stated pretty clearly they don't think they'll need to raise more equity capital. They believe the cash generated from the profitable parts of food delivery out of home, plus maybe selling that Rapido stake eventually, will be enough to fund Instamart's path to profitability and other growth. That's a strong statement of confidence.
Okay, that's a really important signal. No plans for more equity needed. So if you pull all these threads together, what's the main story here? What's the core strategy you see emerging from Swiggy?
Well, what really comes through is this balancing act. On one hand, you have Instamart pushing incredibly aggressive growth, using smart tactics like Max Saver to boost order values and inch towards better unit economics. At the same time, they're not neglecting the core food business. They're keeping it healthy and growing through constant innovation on price, speed, and user experience. Adding users consistently, they're clearly using their existing scale, brand, and logistics network as a launchpad to experiment, like with Snack. They seem to operate with this why not try it mentality for meeting consumer needs and that Rapido stake revaluation. It shows they're also being strategically shrewd, protecting their main interest in a complex market. So it's a picture of a company investing heavily for the future, yes, but doing it with an increasingly sharp eye on sustainable growth and smart economics.
That sums it up really well. A balancing act, constant innovation, and that why not attitude. It's clear Swiggy is really pushing the envelope on what convenience even means. 10-minute food delivery with Bolt, these bigger quick commerce hauls via Instamart, they're constantly reshaping our expectations. And that makes you wonder, right? In this world where we're getting so used to instant gratification, how much faster can things realistically get? How much more variety can be delivered instantly before we hit some kind of wall? What does this relentless chase for speed and convenience mean for how we live in cities, for our own habits? It's definitely something to think about next time you find yourself tapping that app for an instant delivery.